and services. So it's good for you to issue a tax invoice, then you collect your VAT. That's the implication of that. Now, let's look at the issue when it comes to the company's income tax. Now, under the company's income tax, the penalty regime now is basically failure to file your annual return. If you fail to file your annual return, the initial penalty is 25,000 for the first month which you fail to file your return, and subsequently you are paying 5,000 for subsequent months you fail to file your tax return. Therefore, if you're a small company and not to you are required not to pay CIT and education tax, you should not relax, because you have not been filing return every month. You may just tend to relax. This penalty still exists. The law still requires you to file your tax return as at when due, especially your company's income tax return. Even if your turnover is less than 25 million. Now, when it comes to the company's income tax, failure to keep proper books of account. If you fail to keep proper uh, books of account, okay, there's also an issue here. Now, before, we don't have clear provision here, but now the penalty is 100,000 naira initial penalty, and this is the biggest penalty I've seen in the Finance Act, and subsequent penalty is 50,000 naira. The tax authority is kind of telling us that please and please ensure you keep proper record. Now, when they invoke this penalty, they will show you that it's in the law that you are supposed to keep proper record, because when they request for this, they need this schedule, they need that schedule, they need the trial balance, they need this, they need that, and you are not able to give them, as at when due, then of course you are not keeping proper records. So, and it's a big penalty. So, meaning that accounting and record keeping is very key for proper tax management. Okay, so, and I've showed you what we are saying. You could see under this failure to keep proper record, the penalty has increased. The penalty increased, tremendously. 100,000 initial month and 50,000 subsequently. So this is significant. Now, in the Personal Income Tax Act, although they still maintain the status quo, but just to reemphasize that there are some sections that deal with offences. Now, failure to file your annual return for individual is 50,000 naira, and for corporate entity 500,000 naira. And failure to provide proper books of account is 50,000 naira for individual, and for corporate entity is 500,000 naira. And of course, your exposure for personal income tax is to the state internal revenue services. And although if you are a resident of Abuja or members of the armed forces, there are some set of people that will still file their personal income tax to the Federal Internal Revenue Services, although we've dealt with that in the past. So basically, you could see that these two regimes, in terms of penalty, they are definitely is like a penalty regime where we are now. So please and please, you need to see the percentage change. That's why I put the percentage increases beside this slide. So you should see that penalty has gone up astronomically. So it's very good to protect your clients so that you won't start exposing them to penalties that they cannot afford as either small or medium-term entity. So let's quickly look at this example of AB Technologies. Look at this example of AB Technology, and we are going to look at the tax exposure under the two regimes. Okay, AB Technology is a limited liability company incorporated on 4th of July 2018 and situated at 14 Queen Street, Yaba, Lagos. For some strategic reasons, company relocated its office to 10 Agungi Road, Lekki Ajah Express Road on 5th of January 2020. Now, the company deals in repair, maintenance, and installation of CCTV cameras. Okay, a tax audit on the company revealed the following. Okay, the company is yet to notify the revenue on the new address. The company carried out an installation work on 1st of February 2020 for 1,500,000 naira. The company neither charged VAT nor filed any return for the month. Now, the audited financial statements of the business as at 31st of December 2020 shows a turnover of 35,500,000. As at 31st December 2019 was 27,200,000. Now, this kind of tells us that this company is not a small individual. Okay. Uh, we'll be looking at this company required calculate the tax exposure under the Finance Act, calculate the tax exposure in Pre-Finance Act. So this company, as we see, was incorporated on 1st of July 2018, okay, as a limited liability company. So we have that in place. Of course, when after at the end of the end of the year, if you've not commenced operation, you are required to prepare a statement of affairs if you are not started operation. And of course, if you started operation, you prepare an account and file a return. But the issue we are looking at here is what the tax audit revealed and what happened when they relocated from a particular, location to another location. Okay, so when this happened, what the company should have done. So although this company had been filing returns, monthly, but it discovered that that a transaction that they did on installation work on 1st of February 2020 for 1.5 million, the company did not remit the VAT and it did not file any return for that month. So basically, looking at this, and we look at this company, is this a small company? How are we going to know it's a small company? It's not a small company because the audited account, the accounts have showed for the current year, 2020, that the turnover was 25,500,000. So this company has a monthly filing obligation. And even last year, in 2019, they made 27,200,000. So on a monthly basis, this company have been doing this filing. But we noticed that a particular transaction that happened in February did not file. Now, because of this small mistake, or this mistake will not be small by this company, we are going to see the impact of the penalty that this company is exposed to in the Finance Act, and assuming we do not have the Finance Act. No, so I'll share with you uh, the Excel computation, okay, of this scenario that we are looking at. Okay, so I'll quickly share with you now. Okay, so what's happening? Let's quickly remove the grid lines. Okay, so you will see basically what's going to happen here in this scenario where we'll see. Okay, we cancel. Okay, so this scenario we have here is the pre. Now this scenario we have on our Excel sheet is under the Finance Act. So we have it under the Finance Act. Okay, so why this scenario we are having here is Pre-Finance Act. So these are the two scenarios we'll be looking at today. So let's see what's going to happen. Now, under the Finance Act, you'll notice that what has happened to this company, one of the offense is failure to file tax return. Okay, for the month of February, because this transaction happened in February, since this transaction happened in February, for the month of February, there are no penalty. But in March, this company was supposed to file a return and it did not file, and that's the first month for non-filing. Now it's going to pay penalty of 50,000 naira. That's the penalty. Then subsequent month for that particular transaction is not filing, is paying 25,000 naira till the end of the year. So the total this company is going to pay now is 275,000 naira. So that's a penalty just for a transaction. Now, you also notice that this company failed to notify the revenue because the company changed its address, its location, okay, and this change of location happened on a particular day, and it happened 5th of January. Okay, so the company now, on 5th of January, of course, within 30 days, is supposed to notify the revenue. So from February, it's going to pay a penalty of 15,000 naira and subsequent penalties of 25,000 naira till the end of the year. Now we're looking at the tax audit have taken place in 2021, let's say 1st of January 2021. So you could see that this company again did not even remit that VAT. Okay, failure to remit VAT is another kind of penalty. So the VAT itself, the company will need to, pay for the VAT itself. Since they not remit VAT, no remittance of VAT, because of this transaction took place in 1st of February, and that is where the Finance Act, effective date of the increase in VAT, the company is going to pay 7.5% of that amount of 1.5 million sales. Okay, they're supposed to have charged it in form of output VAT. So they are going to pay this VAT, and penalty of 10% will apply, for non-remittance of VAT, and interest will also apply at it has the central bank monetary policy with discount rate, 5% more than the discount rate. So, and this could be varied. It could be 13% plus 5, making 18%.